Hello and welcome to the 7th Annual Global Hog Industry Virtual Conference. I'm Ann Hess with National Hog Farmer. I will be your host throughout the event, so if you have any questions or thoughts, feel free to share those with us in the chat or on social media at any time. Also joining us today behind the scenes for production is Sarah Muirhead, and we also have Kristen Bacher and Julie Strube who will be helping to get your questions to our guests today and will be available if you have any technical difficulties. This morning, we kick off the event with a market outlook. With us today are economists Lee Schulz, Ever.Ag, and Glynn Tonsor with Kansas State University. They will be shedding light on the U.S. pork market domestically and where hog prices may move from here. Welcome to you both, and thank you for joining us today. Glynn, let's kick off this session with you. I believe you have some slides detailing the latest from the meat demand monitor and where pork stands in this current macroeconomic climate. The floor is yours.
Well, thank you, Ann, and welcome everybody for joining us, both live and watching recorded versions later. Hope this finds you doing well. Please note my first slide here. I've got a picture of Forrest Gump. My family, we watch a lot of movies over time, and you might remember this quote, life is like a box of chocolates. You never know what you're going to get. I'm interjecting that to kick us off because we do have, I'd call it some mixed signals and different mixed excitement in the pork industry as we speak. And I'm going to outline some of that specifically on the demand side and then hand this off to Lee, who I'm confident will add additional layers and detail to that. In front of you now, you should be seeing a map of this consumer sentiment index from the University of Michigan. This is an effort that's been around for like over 50 years. We've heard a lot about it in the last 6 to 8 weeks. And I'm interjecting it and I'm starting off my remarks today with it because since the beginning of the calendar year, the macroeconomic situation has become much less certain. Depends who you talk to, if you're excited about those developments or not. But on balance, the U.S. public is much more concerned about the macroeconomic situation. And that's what this sentiment index is alluding to. Specifically, some of the text points I've included in front of you are from the middle of April report. And I'm going to verbally update them with the latest here in a minute. But I think it's important to start actually with this mid-April report because there's a quote I'm going to give you on the next slide. But the punchline is really important was in the middle of April, we had about 11% decline in this sentiment index. And it's a very broad index that brings in multiple things. But declines are pessimism, right? Concerns about the general macroeconomic environment and nearly a third reduction in this sentiment measure since last Christmas. So fairly rapid decline is what I'm trying to press on you. When you look a little narrower at the details of that April report, we had year ahead inflation. So sort of short term, 12 months out, expectations jumped notably. So in the middle of April, they were 6.7%, the highest since back in 1981. I will interject that the latest numbers for the middle of April are actually even higher, so north of 7%. So those inflation expectations continue to rise. Middle of April, those expecting unemployment was rising rather quickly, admittedly from a small base, but nonetheless grew a lot since back in December. And at the very bottom here, I've included a quote. You can read the specifics later, but the punchline would be is it's very common that we have a segment of the public that's optimistic and a segment that's pessimistic. Sometimes that's among political division. So if your political party's, in control of the Senate, House, or the executive branch, you tend to be more optimistic. And the reverse. What really stands out in the April report is sort of regardless of age, regardless of income, regardless of political affiliation, sentiment is declining. So it's fairly universal in this measure. And I'm giving you all of this, not just because you want a macroeconomic, summary, but because it's very important for pork demand. And it's important for meat demand more broadly. The Meat Demand Monitor, which Ann alluded to, is a project based here at K-State. The beef and the pork checkoffs collectively support this effort. It's been going since February 2020. And here's a link to our agmanager.info website where you can get a lot more information on this report and the project as a whole. It is a large national survey we do every month, over 3,000 people. Specifically, what you have in front of you now is a link to a report from early April. Justin Bina, who's a faculty member at Arizona State, and I put this out. And we were looking at what's the implications of changes in this financial sentiment measure that I just summarized for you on meat demand, specifically using the first quarter, so the first 3 months of 2025. I encourage you to pull that up because I don't have time to give you all the details of that. But I'm going to give you the April numbers specifically that followed after that quarterly report. And that's part of what you have in front of you here. One of the things we ask is, how are your household finances today compared to a year ago? And it's a real simple question. Are they better now? Are they the same? Are they worse? In April, 18% of the public told us their finances are better than a year ago. 46% said they're the same, and a little over than a third said they're worse. This is quite important for pork demand and pork consumption for several reasons. First, please note one of the bar charts you're looking at, and these are stacked, there's blues, oranges, and grays there, is reporting how many meals yesterday, so prior day meals, included each protein. And pork is the second vertical bar we're looking at. The way you interpret that data is, if you told me your finances are better than a year ago, you also told me you had 0.61 meals that included pork yesterday. If you extrapolate that to a 7-day, kind of rolling week approach, that's about 4.3 meals that had pork in the past week. Conversely, if you're in that group that's a little more than a third that said your finances are declining, then you only had 0.4 meals yesterday included pork, or over a week's time, about 2.7. So that's a full 40% less frequent inclusion of pork in your meals, is the point. I want to interject, this is not unique to pork at all, but we're pork-centric here today, so I'm highlighting that. And the punchline would be is, when people get concerned about their finances, it tends to hit meat consumption, is what I'm outlining here, and pork that's included in that. We also see our measures of food expenditure take a hit. So the vertical charts that are over to my right, as you're looking at this, we summarize at-home food expenditure as well as away-from-home food expenditure separately for these three groups. In the 3 months starting 2025, there was a large difference between those that said their finances are doing better and those that said they're the same or worse. But we saw a little bit of that disappear in April, and I think this is really important. So economists like Lee and I and others that you might talk to would regularly expect demand to take a hit when finances decline, because meat is what we call a normal good. What stood out in April is even the group that said their finances are doing better tightened down on what they're spending away from home. So this is quite concerning for away from home food demand, and by extrapolation, away from home pork demand. Most of what I gave you on the last slide was a consumption, like an inclusion of pork per meal. Consumption and demand are not the same thing. We've talked about that at length in other webinars. If you've got questions on that, feel free to reach out to me. We can talk about it in the Q&A. But a demand measure that is in the meat demand monitor is a willingness to pay. So how much are you willing to pay for a pound of a different protein? In the middle of the figure I have in front of you, I've highlighted in gray our measures for pork chops and bacon, retail willingness to pay per pound for these three different groups as delineated by their financial sentiment. And let's just use bacon as an example here. So it's the second row that's in gray. That 18% that said their finances are better than a year ago, we estimate for April was willing to pay over $10 per pound for bacon. Of note is the Bureau of Labor Statistics estimates the average price of bacon around the country in April was about $7. So for this group, if they could buy bacon for $7, but they're willing to pay north of 10, then they clearly are anxious to buy bacon. They're going to do that, and they're better off by buying it, right? Because they value it more than the asking price. Conversely, that group that says my finances are the same, and particularly those that say their finances are weakening, has a willingness to pay that's below that average asking price if bacon's not marked down to move it. Therefore, it is a barrier, right? The demand strength isn't there for there to be bacon purchasing for that group. I'm breaking this one down to make the distinction between consumption and demand, but secondly, to hopefully help you see how those that are in a better financial position, things are improving, are much more likely to be paying the asking rate for any protein. And we're just talking through bacon specifically here. Now, a lot of what I've given you here so far is quite bearish. I put some green text on here because I think there's also some positive developments. Hence my box of chocolates comment. It is a mixed bag. I think we need to back up and recognize that meat in general is having a positive moment in the U.S. You should be looking at a picture here of an eagle holding some meat. This is a link to a piece in the Atlantic that was breaking down kind of the meat environment more broader in the U.S. You're welcome to bring that up. I'm going to highlight a couple of the trends that I think are pretty important on that per the MDM. So one of the things we also ask these respondents in the meat demand monitor all the time is, how would you self-declare your diet? Are you a regular consumer of meat products? which is in front of you, and that was 73% of the public in April. That was what they chose. Are you a flexitarian? So you're still a meat consumer, but you intentionally avoid meat in some meals. That was about 11% of the public. Are you vegan? Are you vegetarian? That combined about 9% self-declared number. And then we let them opt out and say none of the above. What I really want to impress on you is the trend over time in those responses. So in front of you now, you have these monthly bar charts going back to February 2020 on the share, and these shares sum up to 100%, that's self-declared to be a regular meat consumer. And please note the purple trend line that I've added, simple linear line, is upward in slope. That is good. That simply means over this period of time, and particularly since 2021, we've had an increase in the self-declared rate of being a regular meat consumer. So that's very positive. Where's that coming from? Where's that growth coming from? It's mainly from a decline in the vegan vegetarian self-declared rates. And that's the downward sloped line that's in front of you on this chart. So it's the same data, just showing you the different trends. These trends are net zero because you had to pick one of those self-declared options. The story's even better than that. Going back to the same Atlantic article I'm referencing, is it's of note that in the meat demand monitor, those prior day meal details I gave you earlier, I have those for everybody, whether you're a vegan, vegetarian, flexitarian, or otherwise. And about half of the MDM respondents that tell us they consider themselves a vegan or vegetarian also told us earlier, roughly 10 minutes earlier in the survey, that they had meat that day. I would call that inconsistent. But what's most important for our discussion today is that also means they're probably not, hopefully we're still going. I got something pop up there. We're not, excuse me for a pause. I had something else come on the computer there. They are not a dedicated, regular vegan vegetarian. They are still buying meat in some ways. So I would actually argue the meat demand monitor effort has overestimated the vegan vegetarian rate. So I gave you 8 to 9% earlier. I think the true number is more like 3 to 5%. So indeed, meat is having a moment. To wrap up my comments here, I think it's useful to back up and do a longer lens. So the meat demand monitor is survey-based data that started in February 2020. You should now be looking at a chart from the Livestock Marketing Information Center. This one is on total expenditures for meat. It goes all the way back to 1998. So let's take like a 25-year look at this. The red line is for beef. Pork is the dotted purple line, and then blue is the broiler chicken line. Most importantly, all three of these lines are an upward slope. And I fit a simple trend line for the fellow geeks out there that want to look at that. If you look at the purple part of this, so purple text aligning with the pork dotted line, is on average over this 25-year period, consumer expenditures in the U.S. for pork have went up about $4.50 per year. That's very good. That rate of growth is actually larger than it is for broiler chicken meat, but not as fast as it was for beef. To add to this, it's really important to recognize that while those expenditures have been increasing in nominal terms, as a percentage of disposable income, they're actually going down. So this is another slide from LMIC. It's still expenditure data, but now it's in relation to your disposable income. And notice all three of these have a downward slope. This is very important to appreciate if you remember where I started off my comments, the broader macroeconomic uncertainty. What has enabled this downward slope is growing incomes on average over this period of time, more buying power over time that has benefited the entire meat complex, including the pork complex. And we should not take that for granted. So to connect this back to my mixed bag, my box of chocolates comment, is a lot of the uncertainty, in my opinion, that is showing up in that consumer sentiment index that was tied to differences in pork consumption and demand is directly tied to the trade discussions and the uncertainty on tariffs and the uncertainty on what they might have. The Economist talked about this in 2023. So I've included a picture here. This zero-sum picture was on their cover. That was an encouragement for it to not think about trade as a zero sum. Personally, I encourage us to think about trade as 1 + 1 can equal something more than 2, right? In third grade math, 1 + 1 is always 2, but economists would say we make the pie bigger, right? We grow the economic opportunities. Hence the 1 + 1 could be bigger than 2. Don't think about a zero sum kind of approach. That's the tone of that Economist article. You want to read it. And I've included as well this trend of populism growing that goes back over 20 years. So globally, there's been this questioning of international connections. It might feel like this doesn't fit our discussion, but I really think it's core to the current environment in the mixed bag. because this uncertainty about like the future role of trade and what does it mean for domestic economic strength is really important to appreciate. And I encourage us to focus on growing the pie, right? I'm very pro trade if you can't pick up on the tone here, but I think that's also core to understanding the mixed sentiment that we're going through. Most of us are familiar with the taste what pork can do. And I am wrapping up my comments here, Ann, is the new slogan, the new campaign for the National Pork Board is, I think, timely to interject here. So I want to do that before I hand this off to Lee, is the pro-protein moment that I've outlined. I think it's important to keep note of the backdrop, the macroeconomics, and watch what's this new campaign. It came out earlier this month. You're going to see more about it. And the only final comments, people can bring these slides up later, is the meat demand monitor is in line with that new campaign. We regularly find taste is a leading contributor to why people buy the protein they do. That is central to the National Pork Board's effort. That's documented and reinforced in the meat demand monitor. I'm purposely going through these last 3 or 4 slides just to make that comment. There's just data for that you can pull up later, but taste leads, quite important. Other things matter as well, but taste is regularly one of the top 2 considerations, and I think it makes sense that we have that at play. A natural segue to hand this to Lee is to give a shout out to some of his research, and that's what my final 2 slides here are, Ann, is the most important question in this new campaign, in my opinion, is how do producers, so live animal producers, benefit from pork demand growth? And some of the recent research by Lee Schulz, who you're going to hear from in a minute, and Ezra Butcher, who's wrapping his PhD up at Iowa State, helps us understand that. In front of you are some numbers from their research, and they quantify how an increase in wholesale pork demand, regardless of how it occurs, if we have a boost in demand at the wholesale level, we would anticipate a 0.4% increase in market hog price, and each additional price gain we have for market hogs gives us a more than a 1% gain in feeder pig and early wean pig prices. So indeed, these what Lee and I would describe as derived demand effects. If we increase demand at the consumer level, the derived demand for hogs goes up. Therefore, you have more higher prices for hogs. That's quantified. And I'm ending my comments there because, in my opinion, this building of pork demand, hopefully enhancing pork demand, indeed does matter to hog producers. Hence the yes, right? There's a clear bottom line effect. Had we accomplished keeping demand stronger in 2023, consistent with 2022, we would have experienced much higher market hog, feeder pig, and early wean pig prices. That's an example of this, hence the green on this slide. And I hope the new efforts on the campaign and broader efforts lead to that stronger pork demand and let us navigate these kind of uncertain macroeconomic waters. With that, Ann, I will show this as our last slide. I promise these slides, I purposely went through a few pretty quick, but everything I click through is going to be on our Ag Manager website when we're done here.
I think we might have some. Oh, there's Glynn. Thank you, Glynn, for that insight. Lee, we'll turn the floor over to you now for a look at production costs and where the hog market is taking us in the near and long term.
All right. Well, thank you. And thank you, Glynn, for those insights and the shout out to our research. I do think it flows really well into here kind of talking about the fundamentals as it relates to demand as well as the supply situation. Before I get into the meat and potatoes of looking at some of the data, I do want to note here some USDA reports in the coming weeks that will help to maybe change or help us better understand some of the fundamentals. I think it's really important as we're going through a very dynamic time in the industry, as well as understanding the value that USDA plays here in providing us the data that we all use. Everything that you'll see in this presentation is publicly available data from mostly USDA sources, with just my kind of take and graphing of that particular data. So, and there's even several we'll be getting a cold storage report here in a couple of days that'll give us the update as of the end of April of where our current cold storage stocks are. I continue to watch the World Ag Supply and Demand Estimates, or by the name of WASDE, that helps us kind of understand not only current production, but USDA's forecasts on some of those production as well as prices and some of those export levels. Importantly, they consider trade policies as of the time of the publication, and the policies remain in place. So as we're kind of going through some dynamic times as it relates to these policies, very important to keep in tune to some of those reports and the forecasts made in those reports. That similarly goes for USDA Economic Research Service, their livestock, dairy, and poultry outlook that gives us, again, those current and forecast production prices and trade. And then importantly, really commentary on the trends that they're seeing in the marketplace. And then just over a month away, we'll be getting our next quarterly hogs and pigs report to give us those inventories as of June 1 to really provide us kind of an update of those pipeline supplies as well as inventories that'll impact medium and long-term production in the pork industry. Now, we did have a report a couple of weeks ago. It's referred to as the PDI report, or the Meat Animal Production Disposition Income and Annual Summary. A little bit of a mouthful of words there. I kind of refer to it as the report card for the animal agriculture industries. And when you look at that for hog and pig production in particular, 2024 was one of the better years on record by several of the metrics that's included in that report. I mean, what I'm speaking to there as far as production levels, value of that production, cash receipts, and gross income really was about the third best year that we've seen historically. Now, I want you to keep in mind as I go throughout the rest of this presentation, the last couple of words I have there on that that phrase on the top, it's by some metrics. And so I think as we think about other factors that have been impacting the market, like inflation, that's had an impact on some of these metrics that we look at from how well we did compared to other years. Now, I'll kind of give you the conclusion before I give you the rest of the slides to think about, what factors are really driving here, what these conclusions are. As we look at consumer level demand, it is below some of the heights that we've seen in 2020 to 2024, but it's still good versus long-term history. As we think about the factors that impact demand, consumer incomes, price of substitutes and complements, tastes and preferences, those factors are going to remain the same, but there may be a little bit of jockeying of which factors are kind of the leading factors impacting demand. Exports were record by volume and value in 2024. Current forecasts are down 8% by volume in 25, but then up 1.2% in 2026. That would be a record then from a volume standpoint in 2026. Again, production costs have declined moderately. Break-evens are still in about the mid-80 per hundredweight on a carcass weight basis. And they're not the only costs. As you look across the whole supply chain, costs still remain elevated. We've seen larger pig and pork production in 2024 compared to 2023 levels. That was due to higher, really, productivity gains. As you think about litter rates and weights, we've seen a relatively flat inventory level. I think as you look at forecasts for 2025, even into 2026, I think some expectation is that continues. And then our hog prices were up 3% in 2024, and current forecasts are up for about another 3% in 2025. Notably, that's just above the rate of inflation. And so as you think about how far those dollars extend, that inflationary level still have an impact. Now, Glynn touched on pork demand. Here is a retail pork demand index for the first quarter of 2025. We were just able to update this as we got kind of the final production piece of the data and could look at per capita consumption. For the first quarter, we did see lower demand, and that was due primarily to lower per capita consumption, down 3%. Now, real pork prices were about even with a year ago. Nominally, we see those prices slightly higher. So we would have had to see a much larger increase in price to offset that lower per capita consumption if we were going to see no change in demand or even an increase in demand. Vice versa, we would have had to see per capita consumption slightly up compared to year ago levels if we were going to see zero demand change, given what the price levels were. I highlight this is because there's several factors at play here of what we think about of how we could achieve an increase in demand, be it either we're going to consume more product or we're going to maybe consume a little bit less product, but at a higher price could offset that lower consumption. Now, to that exact point, if we look at the weekly featuring data for out of the USDA's Ag Marketing Service, they release this weekly, kind of as a look back at store circulars. We've seen a ton of featuring of pork so far in 2025. Here's a summary from the Easter holiday where you've seen a lot of featuring, but that featuring was really helped increase quantity demanded. You had buy one, get one free. You had reduced prices for products, and that really helped from a purchase standpoint, but that doesn't necessarily grow demand because it's at a lower price. And so I think that's important to keep in mind as we see a lot of featuring of products. It is certainly increasing quantity demanded and probably helping from a market share standpoint of more pork on consumer plates. But is that growing the whole pie? I think we have to know more of the pieces as it relates to what price is being paid for that pork in particular. Now, on that, we've seen pork prices up so far about 2% in April of this year compared to April of last year. We actually seen prices a little bit lower from March to April to the tune of about 4 cents per pound. And so you've seen really relatively flat prices for pork, whereas you've seen much higher increases in beef, for example. And when you look at kind of the spread between beef and pork prices, and I highlight this because, as I mentioned earlier, the factors that impact demand, substitute price is one of them. We look at the spread between beef and pork is at some of the highest levels we've ever seen. If you admit May 2020 during kind of COVID-19 impacts, this is the highest spread since June of 1980. It's even higher than the spread back in June of 2015. Kind of thinking about the last time we've seen the low in the cattle inventory cycle and much higher prices. And so, I think there's a lot of debate about how much that cross price matters to demand. But also, I would argue that we've never seen the spread maybe this wide. And so I think we can still continue to debate about how much that substitute price will matter here. Now, as we look at cutout prices, it's really been a kind of a tale of two different stories. For the first 2/3 of the year to date, we've seen prices higher than a year ago. The last 7 weeks, however, we've seen prices below a year ago. And even here, the last couple of weeks, prices have dipped below the 5-year average. Currently, for looking at last week, we're a little over $3 per hundredweight lower than year ago levels. And that's primarily come from all cuts except for the ham and the belly. In particular, the belly, it's been above year ago levels all but 2 weeks here in 2025. And for the belly in particular, that very much aligns with where pork in cold storage is. We see pork in cold storage down about 9% year over year when you look at it in aggregate. But most of that is from a belly standpoint, as bellies are down about 26% in cold storage at the end of March compared to the year prior. We actually added 14% in pork or in belly cold storage stocks from the end of February to the end of March, but still down 26%. Hams have kind of bucked the trend as we've seen higher, stronger ham primal prices, but also hams in cold storage are up a little bit. Now, I think part of the reason why we've seen such tighter cold storage stocks is because of cost. So as I mentioned, we've seen elevated costs across the whole supply chain. As we look at here, costs for cold storage have increased 32% in the last 8 years. They've increased almost 2% from March to April of this year. So I think that's important to keep in mind as we think about the impact on levels of any product in cold storage. Some of the reduction is likely due to the increased costs we've seen to the system here. Our exports, if we look at through the week ending May 8th, we've seen exports, accumulated exports down 14%. Now, outstanding sales are only down 1%. So that is total commitments down 11%. Now, there may be a little bit of a seeming mismatch here as you look at USDA's forecast are for down only 0.8% by volume, and we're currently running about 14% down in those accumulated exports. Now, I think where you need to look is the outstanding sales. We're seeing some of those rates run much higher than a year ago, and I think it's from a USDA's forecast standpoint is we do see further growth in those outstanding sales that lead to accumulated exports. Also, the potential of new trade volumes close to year-ago levels were. Now, as we think about kind of the final component of what's impacting our prices from a derived demand standpoint, we have to look at pork packer margins. Those margins on a net basis are about $6 per head lower in 2025 than they were so far in 2024. We've seen integrated margins. So instead of using a hog price, we'll use a cost of production there. So think about it from a packer-owned standpoint. Those margins are a little bit better, of just above break even so far here as we look at the 2025 data. So I would argue, we're kind of seeing a little bit more of kind of return to norms, at least kind of break even levels as we think about those pork packer margins. That comes off of some historic losses as we've seen in 2024, where we did likely have some excess capacity in the industry that has been squeezed out over the last couple of years and provide a little bit better healthy situation, at least compared to those historically low years. Now, just as costs have impacted other sectors of the industry, certainly from a packer standpoint, those costs, my estimates would be up about 35% since January 2021. You see the real stark increase there and kind of have remained at those elevated levels. And so as you think about, what are the major factors driving packer returns, it's the cutout, the byproduct, the hog price, and then these hog and slaughtering processing costs that remain elevated. Now, I mentioned the other factor driving pork packer margins are byproduct values. And certainly if we've seen one market here impacted and kind of had a direct impact from tariffs and retaliatory tariffs and the uncertainty around that, it's been byproduct values. You've really seen those bottom out here in April. Now we've seen a little bit of a return, but still below last year's levels as well as well below the 5-year average on those values. Now, kind of transitioning to the returns and cost standpoint here, as we look at the latest estimates, they were released in February of cash receipts. USDA has those at $30.4 billion. Nominally, that's pretty close to a record level, but when you adjust for inflation, it's not quite a record level. Just to give you a little bit of perspective here, if you look at those $30.4 billion, that would buy less in terms of goods and services than 2021's cash receipts of $28 billion. And the reason why is because of inflation. So very important to keep in mind as we think about, I started this slide set looking at some metrics showed, 2024 was a pretty good year. And as we look at cash receipts in particular, nominally, those look very good. But again, when you adjust for inflation, those dollars don't go as far. Now, from a cash receipt standpoint, it's twofold. It's the prices being paid as well as the quantity. From a price standpoint, we've seen prices relatively strong, at least compared to historical levels. You go back to 2022, those were the second highest prices ever. 2023 was the 8th highest nominal prices ever. And 2024 was the 6th highest ever. And then as you look at 2025 with 3% higher prices forecasted, those will be even better. So we continue to see, increases in prices over the last couple of years here. 2026, the current forecast would maybe suggest a bit of a step back. But again, historically, these are pretty strong prices. But when you layer that in with cost of production, you've seen returns that were historically low in 2023. 2024 was back to break even. In 2025, we've seen quite a bit of variability. Current forecasts are about a $13 per head profit for the year, which would, if you kind of compare to history, would be a good but not great year overall and compared to those historical levels. Now, costs have been a big driver as we look at those returns. I mentioned, prices continue to be good compared to historical levels, but we've seen costs increase from 2020 to 2025. Those are up still 31%. If you look compared to 2023, that was up 50%. We did see a bit of a reduction, or at least a forecasted reduction here in 2025, but very, very modest at about a 2% reduction. The other thing to really highlight here is if you look at the 2025, it's in the mid 80s. You look back to 2011, 2012, and 2013. The question I always ask is, what is different about these 2 years? Well, it's the 2025 cost for commodities. So right now, that would be a forecast for 2025 about $4.19 bushel corn. If you look back to 2011 and 13, we didn't have corn prices in that level. They were much higher. So what's changed? It's all the other costs of production that have been elevated and remain elevated. The rather costs of production. So as we're looking kind of more short term, we're looking at some of the highest summer profit forecasts since the 2021 actuals. I highlight that because forecasts don't always become actuals, right? And I think, there's still obviously some risk out there as we think about this market, both short term and long term. And then, to maybe kind of put a bow as we look at the overall returns and financial situation for producers, I like to show this cumulative returns. And you can really start back in 2020 or 2023. Here I started at 2020. It kind of shows the situation for pork producers. Now, as prices have improved, we've seen this cumulative standpoint improve a bit to the point that by August of this year, given current forecasts, we would expect producers to kind of turn positive as far as these cumulative returns. Now, that's much better than what the forecast was back in late April, where we didn't see returns turn positive at all as you looked out at that forward curve. Still, though, even if we go out to August of 2026, from a cumulative standpoint, those are still pretty modest returns overall and are very much reflecting the dire situation that really pork producers faced back in 2023 and even the early parts of 2024. Now I'm going to finish this presentation here talking a little bit about production. So it's that other piece of the cash receipts. Talked about prices. Now we'll talk about production. The daily livestock slaughter reports, I would argue, have gotten a little bit of attention as we look at that last column in particular. So year to date, it shows that our hog slaughter is down 2.1%. The question I ask is it really down 2.1%? Now, obviously, by some measures it is. Otherwise, USDA would not report it. But I think it's really important to keep in mind the number of slaughter days here. And so here I walked through a couple of calculations. We've had 2 less slaughter days so far in 2025 than we had in 2024. It's given just leap year versus common year, also how Saturdays have aligned and holidays. So given that, we've seen, yes, 2.1% lower slaughter, but when you kind of account for that, either using a daily average or the weekly data, we are pretty close to year-ago levels, down 0.1 or down 0.4% compared to year-ago levels. And so that's really important to keep in mind as we think about these production levels, where, yes, it looks like levels are maybe tighter than they are, but when you kind of measure, account for slaughter days, we're seeing it pretty close to a year ago. That's very similar here as well. So as you look at the hog and pigs report, as of March 1 inventories, they would have had production actually up 0.2%. We've actually been up 0.5%. So this latest hog and pigs report really, I think, did hit the mark. We were only off about 90,000 head from the actual slaughter, given where that report was at. And so as I think about where those inventories are in the current hog and pigs report that we're all using to kind of benchmark where those slaughter supplies may be, those would be those market hog supplies there. USDA really has them down give it 0.3 to 0.4% compared to year ago levels. So given kind of the accuracy of the report, given where we've seen hog slaughter, those would be kind of my first intention numbers when looking at where hog slaughter is going to be throughout into about August of this year. Now, as I noted earlier, we'll get another hog and pigs report here late June that'll help us update these numbers. But as for now, I think we're using these as a good benchmark of where those slaughter supplies are going to be going forward. Now, a couple of weeks ago here, we did get USDA's first forecast for production in 2026. They are forecasting a 1.3% increase from 2025 pork production. They currently have 2025 pork production up 0.7%. And that is an increase from where, we did see 2024 up 1.8% from 2023 levels. So I mentioned earlier, I think productivity is really the factor that is driving these higher production levels. Inventories have been relatively flat, as was showed on that last hog and pigs report slide. Now, where are those productivity levels coming from? Well, one is we have to look at hog weights, or those slaughter weights. We've seen from a producer-owned standpoint, those weights are up 1.8% versus 2024 year-to-date levels. You could say that's about 60% of the hogs out there. The 40% of the packer-owned hogs, those are down about 0.8% from year-ago levels. So if you aggregate those together, we are up year over year from a weight standpoint, which is adding to that near slaughter levels compared to year-ago levels. So again, why we're expected to see maybe a 0.7% increase in that production is slaughter levels pretty flat, and we're seeing higher carcass weights. Now, I think maybe what the wild card is on how much larger or smaller those production levels could be is we have to look at litter rates. So we've seen exceptional litter rates in the U.S. population here as we look at the Hogs and Pigs Report survey. We are starting to see those litter rates growth, at least increase at a decreasing rate. That makes a lot of sense, though. It's like anything that continues to break records. You start to break those records at a very small margin. And maybe that's kind of what we're seeing with the latest data that showed about a 1% growth in those litter rates. Even at a 1% growth and flat inventories, though, that's going to give us bigger pork production as we think about where those pig crops, what leads to market hog supplies, and then eventually the levels of pork production. So overall, we've continued to get a more efficient breeding herd. We had the second smallest December 1 breeding herd since 2015, yet we're going to produce the most pork production per breeding hog, even at the USDA's forecast of 28 billion pounds this year, which they continue to reduce the last couple of monthly reports that they've done. So my last slide here, a couple of recent National Hog Farmer articles that I've penned, maybe provide a little bit more detail on some of these things that I discussed here in this relatively short presentation. So I'll wrap up there. A few slides here from Ever.Ag on some of our things to keep in mind. Thank you.
Thank you, Lee, for that insight and perspective. We now have time for Q&A. So first of all, Lee, you mentioned about some of your articles. You recently just wrote an article and made me think of what Glynn was talking about with demand having a direct impact on hog prices. Your latest article was about packing plant capacity utilization. Tell us a little bit about that research you and Ezra did on that.
Yeah, so in that article, I did cite also that paper that Glynn referred to from Ezra, and I'll give that paper a lot of credit. It probably was it was due for some research in that area to kind of update a lot of those elasticities and things we think about in the industry that, give us ways, and analysts like Glynn and I, ways to kind of anticipate some impacts in the market. We're always needing to have those estimates available, as well as update those over time as markets change. And one of those factors that we looked at, and Glynn and I have looked at in other analysis that we've done, is changes in capacity utilization at a packing plant and impacts on hog prices. And as we've seen over time in history, you go back to 1998, you go back to 2020, that is a very impactful measure, right? And we've seen there, if you look at about a 1% increase in utilization, that can really decrease prices almost 2%. I think the estimate was about 1.875%. And so that shows that really does matter, that available shackle space for producers does matter. On the flip side, when there's shackles available, right, and there's strong demand for pork, that can really help lift prices as well, because packers are bidding for the available hogs that are out there. So I think that's really important to keep in mind, not only as seasonally as we go into maybe some tighter supplies during the summer, but as you think about, where we are going in the fourth quarter, where we're a little bit tighter to that capacity, impacts that can have, that has impacts on how producers, should both kind of manage some production and marketings, as well as some risk management opportunities.
Glynn, we had a question come in for you, and I know we've done an article with you and Justin Bina about your research on GLP-1 use, those Ozempic, Wegovy people. How is their use influencing protein consumption?
Yeah, good question. And thanks for the memory, whoever put that in there. I try to make the point, we are in a pro-protein. Protein's having a moment, right? I mean, I highlighted that today. And there's several reasons for that. And one of them is exactly this, the GLP-1. I'll call it development. I try to be careful and not call it a fad, I don't think we know how long it's going to go and how big it's going to be. But in the meat demand monitor, we now track, right? We ask a self-declared question, are you using a GLP-1? And we use Ozempic and Mounjaro and others as examples, so people relate to that. And by that metric, almost 15% of the U.S. public says they're currently using a product in that space. And specific to today's discussion, that group also tells us they're much more likely to have had pork yesterday and pay more per pound for pork. Now, this is not unique to pork. It's actually pro-protein across all classes here. But, one of the things I've outlined before is you're more likely to tell me you had a pork chop yesterday, or you had bacon yesterday, or you had ham yesterday, if you also told me you're currently taking a GLP-1. What Justin and I have found in a deeper dive on that is total food expenditures are decreasing for that group. So total calorie intake is going down for that group, but the main reduction is in sugars and some other categories. And there's an increased interest, and because of that increased expenditure, in the broader protein space. So it's a more protein dense diet if you're on one of those products. And that's very favorable for the entire meat protein complex. Certainly worth watching. We're talking here in May. I think it's too early to know how many people and for how long they'll be on that here in the US, but it is very relevant, and 2 years ago was not something at least I was really watching.
Something else worth watching, you didn't talk about Prop 12, but that preliminary data that came out with, I think prices were up 20%. Have we seen any changes since then? Is it stabilized, or what are you hearing from California?
Yeah, I think, importantly, those higher prices are reflecting the higher cost of production, right? As we think about, that impact, and and that's important to highlight too, because as I alluded to, we have cost of production increases across the board, right? So you're only adding to what is higher prices for overall. Now, I think I haven't seen any kind of updated data from some of those analyses. Those a lot of times are really important analyses to do, because you need to tease out kind of all other factors, right? As Glynn and I both alluded to, these markets are not operating in a vacuum, right? There's other factors that are impacting, inflation being one of them, right? Is having an impact. And so, that's important to keep in mind. Also, we do see some adjustments over time. So as more production becomes Prop 12 compliant, all else equal, you would expect that to help ease some of those price premiums or prices, right? And so again, but I haven't seen any updates to some of those adjustments over time.
Yeah, and if I may, real quick, is Lee and I've alluded to multiple parts of recent and ongoing research. This is kind of a call out that's needed, right? I want to interject that here, but specific to the California and Prop 12 situation, the initial impacts of that, and Lee alluded to it, but I'm going to reinforce it because I think it's real important, is not just the higher price; it's also the reduced volume of what was available in California. So if you think through, for example, what's the impact for California residents? In my eyes, right, the way I describe this is there's an economic welfare decline for California pork consumers, both because they faced higher prices and they had lower volume availability. Over time, to Lee's last comment, we might expect the volume availability part of that to get a little bit better, but there's still this longer effect of it's a higher price than otherwise, right? So that evolves, and I'm interjecting that because it's both a price and a quantity effect, and I encourage us to keep up that kind of research over time too.
Seeing in recent headlines, chickens making a comeback at fast food, quick service. With the work you've done in the meat demand monitor and also with the pork board on their new campaign, and taste being there, but also convenience, do you see an opportunity for new products to be marketed out there for pork?
Yes, yes, yes. I'm 44, and my wife picks on me when I interject that, but I do it to timestamp my perceptions of the world to let people know where I'm coming from. Is I think pork in particular, for a couple decades, has been marketed to folks that are my age and older, and sort of a center of the plate, main entree kind of way of thinking. And there's still a place for that, but generationally, meat in general, including pork, is much more likely to be viewed as an ingredient into something. And with that is a convenience of the item, right? Convenience to prep it at home, convenience to buy it at, away from home, so forth. And I think there's plenty of room for innovation that helps with the convenience part, is what I'm trying to allude to specifically there. But it can't come at the cost of taste. So I was pretty brief just to keep us moving today, but I had 4 or 5 slides that people can go back to. Taste is regularly one of the top 2 things we find in the meat demand monitor, and it's a key determinant of why you do or don't buy protein. So I think there's massive opportunity and sort of a call to arms around that opportunity to have innovation that maintains or enhances taste and maintains or enhances convenience. I mean, those are the 2 traits I would add. And there's a part of the public that will pay more for those products. So price is always going to matter, but if those other things are sufficiently improved, they can justify a higher price per pound, and that's the market opportunity, kind of the R&D on innovation. That's the bait for that, and I definitely think there's a benefit of more work and investment there.
Lee, I'd be remiss not to mention your call to arms to respond to USDA's Hogs and Pigs survey. That was quite a popular article. What kind of response are you getting from people out in the field?
Well, and that's been really for me kind of I'll call it a little bit of a passion. I think, because I use the Hog and Pigs report, I rely on it for a lot of market analysis, right? And so the more representative and the more kind of credible we can have that data, I think, really does kind of allow us to do better job from an analyst standpoint. And when you go and talk to, pork producers, analysts, people worldwide, we are really the envy of the world when it comes to data availability, an ability to make some of that market analysis. Saying all that, there's always room for improvement, right? And I think obviously we've seen response rates for that Hog and Pigs survey decline over time. So, as you maybe impact some of the, at least kind of the statistical measures, confidence intervals, things like that, when you think about that survey. So, as I share that with people, I think it's not a surprise maybe, that we've kind of seen that a little bit over time. But also I think, I think it's the willingness of people to say we all have a role to maybe increase that a little bit. I think, from my standpoint, it's probably educating a little bit of the value of this survey. I think, USDA probably has some opportunities to maybe, market it a little bit more, make it more visible from that standpoint. And then obviously producers, when it comes down at the end of the day, they're going to need to respond to that survey. So hopefully kind of that helps it really kind of grow those response rates over time. And, we maybe the next time we talk about it, it's kind of, the higher response rates. And, as I shared here, the Hog and Pigs report survey was pretty accurate as we look at the last slaughter numbers. And that's really always the hope. I always like to share that, it's really much more accurate than the latter case there.
And briefly, if I may, as a quick add-on, we're 2 weeks from World Pork Expo, and I suspect quite a few of our attendees here will be at part of that as well. One of the sessions that's planned is actually by USDA clarifying, and I'd just say kind of educating how the pork cut out process, right? Wholesale pork price reporting works. I'm interjecting that because it's more than just the hogs and pigs report, and I know Lee concurs with this. There's a lot of market information we get primarily from various USDA efforts. And I think all stakeholders are well served to periodically back up and sort of understand where that comes from and then do your part to participate. And there's always room for improvement on all those, but there's a specific opportunity at World Pork Expo to get more informed on, how the cutout part and wholesale pork works. And those that have an interest in this, I would encourage them to seize that opportunity while you're in Des Moines.
Great point. Remind the audience, if you have a question for Glynn or Lee, please post those there in the chat or in the comments if you're tuning in via social media. As we wrap up here, Lee, I was going to ask about, you touched on the impact tariffs have had. How about the plant renewals? Did we see any impact there from China? And also, if we're still having issues with, where are we going to place the byproducts? Where are they going to go if we don't have a deal struck, I guess, in 90 days?
Yeah, so we did see the renewal process. It did come down to the midnight hour, but we did see those being renewed. So think of that as more of a non-tariff barrier potentially, right? Here, but we've also seen obviously an impact when you look at tariffs and the rates that they were at. China for much of that byproduct is the highest valued market. And unfortunately, the next highest value market, which not a lot of times for a lot of cuts, but for variety meats is a pretty big, large step down. And that's why I think we've seen some of those byproduct values decline so much as USDA reports them. Now, I think important to keep in mind is, not only might there not be other markets for at least the volume standpoint, so it might have to clear at a much lower price. But also, we do not have the capacity to render all that product as well. And so that does provide a bit of a challenge. One of the National Hog Farmers articles I wrote, is, does cold storage provide a buffer? It does, but very short term, right? And that's what cold storage, part of it, the role is kind of those short-term adjustments in supply and demand. Interesting, we actually have seen a lot of featuring at retail for variety meats. Again, I think as a short-term adjustment, as some of that product has not flowed through the export market, we've had to consume it more domestically, and you've seen a lot of featuring for that. So, markets are remarkable for adjusting. Short term, there's sometimes some pinch points, but I think the hope is here we do see some adjustments. And as you've seen in that one slide, we did see the byproduct values start to increase off of kind of some of the lows we've seen earlier this month.
Lee Schulz and Glynn Tonsor, as always, a pleasure to have you be part of this event. Thank you for sharing your insight with us today.
Thanks for having us on, Ian.
Thank you, everyone.
We also appreciate all of you being with us. There's a lot more ahead today, so please stay with us. Up next, we talk 2025 trade policy priorities with Maria Ziba of NPPC, followed by Megan Niederwerder with Schick on foot and mouth disease. Hope to see you in both sessions.